I'm about to teach you everything that you need to know about liquidity sweeps and make you a ton of money. As you can see, I literally just passed a 200K funded account with this. Online, you're gonna hear so much stuff about this, but the most important thing is liquidity sweeps, and we're gonna go through them right now. I'm gonna show you exactly how you can replicate what I do on a daily basis and what has gotten me to multiple millions in funding. I'm not gonna waste your time, let's get straight into this beauty. Okay, so the first thing we need to do is spot the liquidity. So how are we going to do that? Liquidity is really simple. It is a 2-candle movement. It is up and then down, or it is down and then up. That then means these little bits right here are liquidity. That is liquidity. That is liquidity. To explain it really simply, the market moves in trends. We either have a downtrend like this or an uptrend like this, which is obviously lower highs, and then here in an uptrend it is higher highs. Now, why is a liquidity sweep important? Why does it happen? Why is price incentivized to sweep liquidity before it moves? Now, that is because market makers are obviously going to want to get better entries. Instead of buying here and then taking your money out here, why would you not just enter your trade here and price goes down here? You see, that is a much bigger movement. The second reason, when these banks are trying to trade and they're trading with tens and tens of millions of dollars, there isn't simply enough liquidity sometimes for them to enter their trades. So when a lot of people have their stop losses here, there is a lot of liquidity that is resting around this high. So price is incentivized to come and sweep this high, which gives us more liquidity, which is obviously a liquidity sweep. And then it allows the big institutions and the market movers to get a better price. Hopefully that makes sense. And now I can simply just show you examples of how you can use liquidity. Now, the first thing you want to do is you want to go on a higher time frame. For example, I like the 1 hour time frame, and you simply want to find points of liquidity and you want to mark it out. As you can see here, we have some liquidity which is resting up here. It has been a movement up and then a movement down. Now, this will work in any session. For me, I mostly trade New York, so this is the sessions I'm going to give examples for. So as we're coming into New York session, I'm going to be going into the higher time frame, and I'm going to be marking out the highs and the lows of the previous session and the previous day liquidity. So as you can see, we have these points of liquidity here for the highs, and then for the lows, we also have some liquidity here as well. Now we're going to drop down into the lower time frame. As you can see, we're going to drop down into the 5-minute time frame. And as you can see, this candle here is the start of US session. So we're simply just going to wait now for a sweep of liquidity, either high or low, and we will wait for a reaction. Now the liquidity has been taken out, we want to make sure that we see a valid reaction. We get a close above here with a very nice, strong engulfing candle. So now that is a bit of confirmation. But are we going to enter off of this candle? No, it is not enough confirmation. Now, you guys can use whatever confluences that you want, but you need to be using more than just one confluence. For example, I like to use a lot of engulfing candles, break of structures, and inverse fair value gaps in my entries. So here, what have we created? We've created a lovely bullish fair value gap, which I'm going to be looking for price to retrace into, respect, and close out of. Now we've tapped in, I'm waiting for us to tap out. As you can see, perfect, we've closed above. We've now tapped in and filled this fair value up at 50%. We have then closed out of it, and this candle here breaks structure again to the upside. So now I know that we are going to be bullish and we can enter this trade. So now we've got our liquidity sweep, our break of structure to the upside, and our fair value gap that's been filled. We're going to enter this trade, and our stop loss is going to go just below the fair value gap. And our take profit, we are going to obviously be targeting the liquidity from the previous session. We're then going to let the trade play out, and as you can see, that was a perfect trade. Right, another example here, we have liquidity up here, we have liquidity down here. Where else do we have liquidity? I mean, we also have an imbalance here that price is going to want to come and fill. And we are about to go into our session, so we are going to go into a 5-minute time frame, and we are going to wait for a high or a low to be swept. Now price has gone above the liquidity. We're now waiting for confirmation that price is now going to go below it, sweep it, and break structure and give us some sort of confluence to enter. We get a lovely break of structure here. We get a bit of a retest. Now we need another reason to enter. Here it is, we get another break of structure. So what's happened here is we've swept the liquidity, we've broken structure to the downside, we've then retested, failed to obviously make a new high, we've respected the liquidity, we're moving down again, and we have closed and made another lower low. So we made a lower high and a lower low, showing us that we're in a downtrend. So we're going to be entering off of this candle here. Stop loss is going to go just above the liquidity, and our take profit is going to be targeting the previous session liquidity, which is down here. And maybe you could have a second take profit for this imbalance, which we can do as well if we want to, maybe put it at about 50%. And we can watch this trade play out, see how it does. Liquidity is absolutely everywhere in the market, and you need to be paying attention to it. Because at the end of the day, liquidity is really what moves the markets. It is how, and hang on, there we go. It's just actually interrupted me here because it has just moved so nicely. But there we go, in and out. But this is what I'm explaining. Liquidity is what makes the market move. Price is aiming to always take out liquidity to then be able to move in an opposite direction. Now, sometimes you can't just enter off of a liquidity sweep because obviously that's stupid, you know. If price 100% of the time just swept liquidity and then went in the other direction, the market would literally just do this forever, you know? So sometimes when there is liquidity, it's not going to get respected. As you can see, we've got some liquidity here, and it's just obviously not respected, which means you would not be taking a trade. So as soon as price goes to liquidity, you can't just enter a trade the opposite way. You have to wait for your confluences, whatever they are, and you have to wait for your reason to enter. Like for example, obviously I'm looking for an engulfing candle, a break of structure, I'm looking for an inverse fair value gap, I'm looking for, you know, a fair value gap to enter. Whether that's bullish or bearish. There has to be many things that you look for, but that is how you use liquidity. That's why it's so important, and that is how you are going to make a lot of money in 2025 trading.